Hi, welcome to Hospitality Accounting. Today we're going to work on Chapter 12, which is how to analyze hospitality financial statements. So we're going to go over some common analysis techniques that are outlined in Chapter 12. So the first thing we want to talk about is what a financial statement package is. A financial statement package includes the three basic financial statements: the income statement, the balance sheet, and the cash flow statement. Also generally included in there is the statement of owner's equity. And then we're going to have the notes to the financial statements. The notes to the financial statements are integral to the financial statements themselves, and they really can't be viewed apart. You need that information to have a full and complete picture of the business's finances. Some of the things that are in the notes of the financial statement are accounting policies, methods of accounting used, any lawsuits that the company is in, and procedures for income taxes. You'll also see an audit letter if it's a public company. Public companies that are traded on a stock exchange are required by the Securities and Exchange Commission to have an audit done. Some companies that are not traded, that are privately held, you may still see an attestation statement. That means that an auditor has come in and done some review work that was less than an audit. That is occasionally required by private companies that are working with the government, that must be bonded or can be required by a financial institution. However, it would be rare for you to see the attestation statement unless you worked for that company. Since it's privately held, you couldn't find it on the internet. A public company, all the information, the notes to the financial statements and the audit letter would be available generally online. So the first type of analysis we're going to talk about is common size analysis. In common size analysis, percentages are used to get a better understanding. So that when you're talking about a particular subject matter and you say, well, that cost us $50,000, it gives you an idea of what $50,000 is. Is $50,000 1% of net sales, making it rather small? Or is it 75% of net sales, making it a relatively large item? So it just kind of helps you to understand how the numbers fit together. And it is very helpful, I think, in understanding the impact of a line item. So to come to a common size analysis, what you need to do is you need to divide the dollar item of the line item. So it can be anything. You could be looking at expense items like salary and wages. You could be looking at food cost. You could be looking at just about any number on the income statement. And then you would divide by net sales. So we could take, let's just say, 100 and divide it by 200. That would be 50%. So very easy common size analysis. We'll go on to the next screen, which talks about another type of analysis. This is comparative analysis. Comparative analysis can be used in two ways. One is to compare prior periods. So you could look at last year's sales or last month's sales, or you could compare to budgeted amounts. I went ahead and gave you an example of comparing to budget, but it's also very common to compare to the prior period or several prior periods so that you can get an understanding of how a business is trending. But we'll look here at budget to actual. So here our sales were budgeted to be $100,000 and our salaries and wages were budgeted to be $65,000. Our actual sales were $120,000, so it was $20,000 over budget. When you're talking about revenue, that's good. So you want to be over budget for sales, and the variance was 20%, so that's a significant variance. For salaries and wages, we were slightly under. We were under budget by $2,000, and since this is an expense item, you want to be under budget. You want to be spending less than you budgeted for in general, and the variance is a 3% variance. So that's not very large compared to the 20% variance that is compared. Now this is not a common size analysis. So the 3% is comparing the difference between the $65,000 and the $2,000, not from a net sales number. That's a different type of analysis. So the comparative analysis lets you look for trends, lets you look to see if what you budgeted for is what's actually happening. Another type of analysis that is often done is ratio analysis, where you go through and you compare two numbers on the financial statements and look at their ratio. Two ratios that the book spent some time on is the current ratio and the quick ratio. The current ratio shows the ability to pay current liabilities. So if you're looking at the formula there, it says current assets divided by current liabilities. We want to make sure that we have enough current assets to pay our current liabilities, make sure we're able to pay our bills. A ratio below 1 means the company may have trouble paying their bills. That means you have less than $1 in so if you had a ratio of 1, that means you have $1 in assets for every dollar you had in current liabilities. Obviously, if you had only 90 cents in current assets for every dollar in current liabilities, you're 10 cents short for paying your bills. So that can indicate a cash flow problem or a liquidity problem for the business. The asset test or quick ratio is very similar to current ratio, but it excludes less current assets. So it may exclude things like inventory and prepaids, like prepaid insurance and prepaid rent, because it would be harder to get those back in cash. And they are both liquidity ratios. Next, we'll talk a little bit about the statement of cash flows. The statement of cash flows is used quite a bit for analysis of a business. There is a move towards something called free cash flow as an indicator of how well the business is doing. But remember that a GAAP business, a business that's generally following generally accepted accounting principles, is recognizing revenue when earned, not necessarily when cash is received. And again, matching expenses in the to revenue in the period they help to generate it. So not necessarily recognizing our expenses when the cash is paid either. So this helps us to concentrate on how much cash is in the business. And many, especially small businesses, have difficulties with cash flow. Their businesses can be cyclical, or they're having income because of depreciation, which is a non-cash expense. So this is important to look at. The statement of cash flows is divided into 3 major sections. Operating section deals with the day-to-day activities such as paying operating expenses and cash received from revenue. Investing deals with cash used to purchase long-lived assets, as well as cash received from the sale of investments or long-lived assets. So if you are a restaurant and you're purchasing a refrigerator, that sale would go here under investing. Financing is anything that has to do with financing the business. So the issuance of capital stock, the purchase or sale of treasury stock, the payment of dividends. That would all be in the financing section. Generally, the operating section is the larger of the 2 sections. And there's 2 ways to prepare the statement of cash flows. One is the direct method and the other is the indirect method. The indirect method is probably the most common used of the 2. So, and then finally, cash is reconciled in the statement of cash flows from its beginning balance to its ending balance. So we'll start with cash on January 1st. They'll go through how cash came in and out of the business, the inflows and outflows in the 3 sections, and then it'll reconcile to the ending balance of cash. So we'll take the beginning cash and add or subtract the inflows and outflows, and the ending cash should match what's in the checking account. So it's a nice check to make sure that you have accounted for everything in that reconcilement. I thank you for watching the PowerPoint for Chapter 12. Please be sure to read Chapter 12 in your text. And thanks, and have a great day.